I'm writing this at the start of 2026, and if I'm being honest, it's over the background of noise that's become the soundtrack of my home over the last few weeks as the kids have been home from break. The kids keep running through the house for weeks now, incessantly shouting, "Six, seven," and they repeat it ad nauseum at the dinner table or in the backyard or even when they're supposed to be sleeping. The trend of shouting that doesn't actually mean anything, but I've heard enough times that the sight of a thermostat that accidentally is set to 67 degrees sends a chill down my veins. It doesn't make any sense. Just because one of them started doing it, they've all joined in the loop of repetitive nonsense simply because it's what everyone else is doing. As I look back at the markets in 2025, I realized that a lot of the grown-ups in the investing world weren't acting much differently. The year began in the grips of the tariff tantrum. In early 2025, the headlines about the global trade freezes and the 1930s style protectionism triggered a panicked exodus. It reminded me of the scene in Monty Python and the Holy Grail where the knights encounter the killer rabbit. One look at that perceived danger, and the collective market let out the cry of "Run away! Run away!" Investors just dumped assets with a total disregard for what the fundamentals were, sprinting away from anything that looked like a trade risk in frantic search of a cave to hide in. By the second half of the year, the "I know" school of forecasting was proven wrong once again, and the fear vanished, replaced by a desperate elbowing your neighbor brand of greed. Coming out of the Christmas season here, it reminds me of the market turning into the shopping mall scene from Jingle All The Way. Just as all the frantic parents fought tooth and nail to get their hands on the Turbo Man action figure, investors engaged in a chaotic scramble for the priced for perfection US mega cap growth stocks. This behavior highlights a strange quirk of human psychology, our tendency to chase and repeat things that are, frankly, kind of senseless. Whether it's investors piling into stocks with valuations that defy the laws of physics, or the way my kids have spent the last month incessantly repeating 6, 7 for no discernible reason, people get caught in a loop of nonsense just because everyone else is doing it. As we open 2026, we find ourselves in a bizarre reality where both fear and greed occupy the same room. Usually, when the safe havens spike, stocks are in the gutter, but today we have both. We have extreme greed, where a handful of US tech giants are priced as if they will never miss a penny of earnings again. The multiples have reached levels that require a future of flawless execution. Secondly, we have extreme fear. Gold has hit record highs, and silver saw a staggering spike of nearly 170% in 2025. So one group is betting on techno utopia, while the other is hoarding hard assets because they're worried about the math of our national balance sheet. While these two groups scream at each other, the great ignoring has taken place, with the vast majority of stocks, the steady, productive, and businesses that actually generate cash flow are being completely overlooked. But perhaps this is starting to change. People are starting to take notice of the ignored and the unloved. The most significant shift in 2025 was the great awakening of the international markets. After being somewhat ignored for nearly 15 years, international stocks finally stepped out of the shadow of US exceptionalism. In 2025, the MSCI All Country World ex USA Index, that's a long way to say the international index, quietly outperformed the S&P 500 by a significant margin. There's several key reasons why the world is finally looking abroad again. First, the dollar has weakened. After years of relentless strength, the US dollar finally softened, falling nearly 10% against other major currencies. This acts as a tailwind for the US investors who are holding foreign assets, as those returns are worth more when they're converted back into a slightly weaker greenback. Secondly, there's a valuation gap. Entering 2025, non-US stocks were trading at a very large discount, in some measures roughly 35% cheaper than their US counterparts. Investors finally realized that you could buy productive world-class companies in other places like Europe, Japan, and the emerging markets for a fraction of the price of US technology. Within international, even better news was international small value. That was the quiet superstar of 2025, with some indices posting returns of 40 or even 45%. Yet, despite this massive outperformance, it remains almost entirely forgotten and ignored and deleted from most portfolios. While the financial news cycle is obsessed with the Turbo Man-like scramble for all the AI chips and then the runaway move into gold, these productive, deeply discounted businesses in Europe and Japan are making money hand over fist without any fanfare. It's a striking example of how the loudest parts of the market aren't always the most profitable. I think the lesson of 2025 is that when the crowd is either running away from a rabbit or fighting for a Turbo Man or just shouting 6-7 at the top of their lungs, we should take heed of the advice of the investor Brooke Berkowitz. Ignore the crowd. We remain diversified, tilting towards productive assets found in small and value corners of the global market. Our goal isn't to try to predict the next spike in silver or the next AI breakthrough, but to own a broad cross-section of the world's most profitable, undervalued businesses. In a world that feels increasingly abnormal, sticking to a disciplined, diversified, and valuation-aware strategy is the only way to maintain your sanity and your capital.